David Hernandez, Community Services Manager of Parent and Resource Center for Madera Unified School District. Welcome to this evening's webinar dedicated to providing you information concerning mortgage loans. It's the process for getting financing. This webinar is being held in English, and the Spanish version will be offered on Thursday, April 29th at 6 p.m. This webinar is one of a series of 5 information-packed topics related to financial literacy. The Financial Literacy Services incorporates real estate, the home buying and selling process will be featured on May 4th. Credit repair, repair the past, prepare for the future, that's on May 11th. And the benefits of insurance, how to prepare for life's uncertainties, that's on May 18th. Please monitor your Parent Square for reminders and access to links to join the upcoming series of financial literacy webinars. This evening, we are joined by Mr. Isidro de la Torre, a broker. He's no stranger to Madera. He works in Madera. He does business in Madera. He used to be in mental health practitioner here in Madera. So Isidro, welcome back. Thank you for joining us and addressing the critical financial steps that we must consider in preparing for securing home loans. If you have questions concerning information being shared through the webinar, please use the question and answer at the bottom of your screen. Your facilitator will take time at the end of the presentation to address some or all of your questions as time permits. This webinar is being recorded to make the webinar available to others who could not join us. The webinar is also live on Facebook. The recording of this webinar will be available via the MUSD website at www.madera.k12.ca.us within 48 hours. As you were waiting for the webinar, I hope you enjoyed the commercials and information related to the great opportunities and resources that are available to all Madera County residents. We will continue to highlight many of the community partners through our series of webinars and workshops. We believe we must continue to share essential community resources and programs to help families struggling in a specific area or just dealing with an urgent situation. We are in it together. We must support each other now and during this pandemic and beyond. And now it's time to enjoy the webinar. It's a pleasure to introduce Mr. Isidro de la Torre. Thank you for joining us.
Thank you, David. First of all, I want to say thank you to David and everybody else for inviting me and giving me the opportunity to educate the public about mortgage loans and whatnot. I'll talk a little bit about my experience first. I am a co-owner of Allstate Homes and Accelerate Home Loans. We serve the Central Valley, Madera, Tulare, Fresno, all the surrounding areas with our real estate and financial services, home loans and whatnot. So I've been in the mortgage business going on about 18 years, 18, 19 years. I kind of lost track already, but I've been doing it that long. Been able to help thousands of families obtain financing to get a home loan, which is probably, one of the biggest barriers in getting a home is finding the right loan. And we're going to be talking a little bit about that today on what do I need to do to get a home loan? Because if you don't have cash, then most likely you're going to need a loan, and most people don't have $200,000, $300,000, $400,000, $500,000 sitting in a bank account. So they're going to have to go to the bank or some bank to get a home loan. So I can go ahead and start with my presentation here. Let me go ahead and just screen share and kind of get things kicked off here. So can you guys see that? Yeah, okay, good. Well, let me go ahead and start then. So here we go. Okay, there we go. So the home buying process, this is what I'm going to be covering tonight or this afternoon about the home buying process. It is basically very simple. I'll go into detail, but this is just the beginning of it. You would initially need to make an appointment with a loan officer and bring in your financial documents, and we would run your credit. So that would be the first step, is to contact the loan officer and say, hey, the loan officer is going to say, hey, well, can you bring in certain documents, which we're going to cover in a bit here. and then they would run your credit. So we'll talk about credit scores and whatnot in a little bit here. Then you would get approved for a home loan, and the loan officer would give you a pre-qualification letter based upon your credit and income. So of course, what you qualify is based upon how much money you make versus how much money you owe every single month. So you would get a letter from a loan officer saying, hey, you are now qualified for, an example would be 200, 300, 400, $500,000. Okay. Then you would select a licensed real estate agent to go out and start showing you properties. Then you would begin to look for and visit properties. Of course, things have changed so much with pandemic. Actually, the financial services and the real estate uh, uh, agencies have never stopped working through the pandemic. So we're able now, we're putting people on what we call auto prospecting, and they're able to see homes online. So things have changed so much in the last, I think year already. So anyways, you would begin to look for properties online or in person. And then when you see a home you like, you would make an offer and you would get the offer accepted. Okay. And once you get the offer accepted, then what would happen is that you would open escrow. Okay. And then once you open escrow, then we'll talk a little bit more about that. But then you would, do your inspections. And if you have any repairs that you request from the sellers, you would do that. Then, it typically takes about 30 days to close an escrow. So that's just kind of like a quick, summary of what we're going to be talking about. So let me dive into what we're actually going to be talking about. So what are you going to need to get pre-approved for a loan? So it's very simple. So to be approved for a loan, we're gonna need to know about your source of income. Okay, so what do I mean by that? So we need to know where you're working at, how long you've been working at, what type of work you're doing, if you're receiving any type of overtime, because we can use overtime to help push you to qualify for more house. And typically we'd need to see about 2 years of consistent overtime to qualify that income uh, to add it on to you to qualify for more of a house. So we would need to see all your sources of income. Some people actually work more than one job, so they may have like a full-time job, and then on the side they have their own business. So we can use both those documentations as long as you're reporting to the IRS. So if it has to be taxable income that you're reporting. So if you're getting income that's what we call under the table, cash income, not reported to the IRS, we can't use that income to qualify you for a loan. So it has to be all reportable income. So that's the type and sources of income that we need to see in order to help qualify you for a loan. And so the other part would be your credit score and your credit history. So you need to have a certain, depending on the loan program, you would need to have a certain credit score. So typically we like to see a credit score of about 640 on up. And then we need to see a credit history. So there are programs that help you. A lot of people think that because they have maybe some collections that they don't qualify for a home loan, but that's not the case. There are programs out there that help people that maybe have, a little bit of tarnished credit and they have some collections. They can still qualify for a loan. Okay, so we would look at your credit history as well. And so if you've given us the necessary information, then this will help us pre-qualify you for a home, and filling out the application and giving us the correct documents and whatnot. So let's go on to the next slide here. So let me just tell you exactly what we need. Okay, so this is what you're going to need to bring to an appointment with whatever particular loan officer you decide to choose to work with. They would typically need the following: 2 years of signed tax returns, okay, with your W-2s. If you're self-employed, let's just say you own a carpet cleaning service, okay? Let's just say you have a carpet cleaning service and you've been running it for 10 years, then we would need to see your tax returns. And the way we figure your income is what we call your Schedule C net. And so we would see how much how much income you're being taxed on, and that's how we would determine your income if you were self-employed. So you can be self-employed and you can be W-2'd and you can still qualify for a loan. You just need your 2 years tax returns, okay? So also what we would need is your 2 months bank statements. And the reason we ask for this is because we need to see, depending on the program, how much of a down payment you're going to need. And we need to see proof of your down payment, because if your down payment, let me just give you an example, like on a $300,000 house, if the loan program you're using is 3% down, that's going to be $9,000 down. So then we would need to see that you have the money already in your bank account as a down payment. Or there's a thing called gift funds. Let's just say you don't have the $9,000, okay, as a down payment, but your mom is going to lend you the money, or your dad or your brother or sister. That's fine. We would need a copy of their bank statements to show that there's proof of down payment, because we don't want to get things started and then at the very end there's no money, okay? Number 3 would be 1 month pay stubs. 1 month pay stubs. So you have to be actively working in order to qualify for a loan. You can't be on unemployment, okay, and come into the office and qualify for a loan. You have to have at least 30 days of pay stubs. You can have been on unemployment, like a lot of people. I'll give you an example. A lot of people during the pandemic, they were on unemployment, but now they're back to work. So all we need is 30 days of pay stubs, and then we can qualify you for a loan. It's okay if you were on unemployment maybe the first part of the year, but now you're working. That's not a problem, okay? But we would need to see your income, the type of the job position you have, if you have any overtime that we can use maybe to qualify you for more house. So that's what we would need for as far as pay stubs. Of course, we would need your social security card as well too. So just a copy of your social security card, a copy of your California driver's license, because at the very end you'll be signing loan documents, and the notary is going to need your driver license or an ID to identify you as a person, because you are making a 30-year commitment, okay? Also too, if you wanted to refinance, typical loan companies will also do refinances. We would just need some additional documentation like a mortgage statement, property tax bill, and homeowners insurance. And as you know, there's a lot of people refinancing right now because the interest rates are historically low. Range. I mean, right now they're probably anywhere from, they've gone up a little bit, but 2.9 to 3.5, depending on your credit score. Still able to help a lot of people lower their monthly payment. And also they're thinking, well, maybe it's going to reset my loan for 30 years. No, banks are now offering, if you have like 20 years left on your loan, you can ask them to refinance you into a 20-year loan instead of 30-year loan, so it doesn't reset you all the way to 30 years. Or you can even do what a lot of people are doing. They're taking advantage of the opportunity to say, I have a 25-year loan or 26-year loan or 18-year loan, and they're refinancing their loan to a 15-year loan, and they're cutting their payment lower, and they'll be able to pay off their home in 15 years. So that's another option that you can think about, especially right now, because these interest rates, they may not stick around for long. We just don't know. The Federal Reserve has said that they will keep the rates low to the end of this year, but we just never know with things are going on. So but that's on refinances. Let's continue on talking about purchasing a home. How much is it going to cost me? Okay, I understand that. I understand what it's going to take to what I need to bring in to get a loan. Okay, I understand that, but I want to know what it's going to cost me to get a loan, right? To get a house. How much does it cost me to get a house? Well, down payments are typically ranging from 0 down, okay, up to 20% down. If you're buying an investment property, then the bank's going to want typically 15 to 20% down. But there's also programs that are 0 down programs. If you don't have any money for the down payment, there's programs that are 0 down, and I'll talk a little bit about those more in detail. But they're all those are the type of down payment programs that are out there. So typically you would have to put some kind of down payment down. That would be the first cost. The second cost would be what they call closing costs. Okay, closing costs are typically about 2% of the sales price of a home. So on a $300,000 home, your closing costs are going to be about $6,000. Okay, and where is those closing costs going to? They're going to a lot of different places. They're going to close the deal out, consummate the loan, and typically they're going to pay for title and escrow fees, upfront mortgage insurance, upfront homeowners insurance, upfront property taxes, notary fees, lender fees, those kind of things. So those would typically cost about 2% of the sales price of the home. Okay. There's also appraisal fees, which also are included in the loan and the closing costs. Typically, you would have to pay an appraisal fee of about $450 to $550. What is an appraisal fee? What is that for? The bank will not give you a home loan unless, okay, they send out an appraiser, and that appraiser gives a value of the home. So you'll typically will never overpay for a home. So example would be like, let's just say a seller is asking for $400,000 for their house, okay? And you tell them, I'll give you $400,000 for the house. And then the bank sends the appraiser out, and the appraisal comes back at $350,000. So the bank will only lend what the appraiser has said the home is worth. So the bank will only lend $350,000. So that's a protection for you, so that you don't overpay in a home. Okay, and I understand now, nowadays, if you've kind of kept up with the real estate market, people are actually overpaying. They're actually paying more than the appraised value for the home. Okay, but typically, the appraiser is the one that determines the value of the home, and the bank will not lend more than the appraised value of the home. And so you can also, save a little money by negotiating with the seller, maybe to help you with closing costs as well too. But typically, we're not seeing that in today's market. It's actually very difficult to do that right now. Or you can ask the lender to help you with closing costs by increasing your interest rate. Okay, so that's another way. So there's a lot of different ways. So a good loan officer can structure your loans so that they interview you and they tell you, hey, how much money do you have available, and they can structure your loan so that they can take advantage of maybe some savings from other people, and get you into the home. So it's called structuring the loan, and it'll get you to basically get the house here. So let's move on here to the next slide and see what we got here. Okay, so different type of home loans. So let me talk a little bit about the different type of home loans that are out there, so that you kind of get a general idea of what's available out there for you as a consumer. So the first one is one of the most popular ones that you probably heard. It's called the FHA, Federal Housing Administration. It's one of the most popular loans because you can apply for this loan with less than perfect credit. So we see a lot of our borrowers with maybe credit scores that are a little bit lower than normal, or borrowers that have maybe their work history is kind of choppy, or maybe they have some collections and maybe a bankruptcy or a foreclosure or a short sale. They have those on their record. Well, the FHA program helps people like that because their requirements to get the loan are not as stringent or strict as we say a conventional loan. So this type of loan may work for you. The down payment is 3.5%. So just for the down payment, so an example, on a $200,000 house, the down payment for an FHA loan would be $7,000 for the down payment. Okay, and you would need a credit score of about 640 or higher. And so if you have a credit score than 640 or lower, you wouldn't qualify for that program. Okay, typically you wouldn't qualify for that program. It would be more difficult to qualify. So we'd like to see people with maybe a credit score of about 640 on up for the FHA program. So it's a good program if you have a little bit of tarnished credit and whatnot. And we understand life gets in the way. People lose their job, they fall behind on some payments, or they get a divorce, or they get sick, or an accident, and so typically, you might fall into that category. So that's one program there. That's a good program. We do a lot of FHA loans in Madera, in Fresno. So that's a good program there. The next one is called the Down Payment Assistance Program. It's an FHA, a conventional product, but this one can pay almost, most of you, if not all, your closing costs. So the down payment assistance programs, what they do is they come in with 3%. So if you're paying, if you're required to pay 3.5% down, the down payment assistance program will come in with 3% down, okay, and you only have to pay 0.5% down. So an example, on the $200,000 loan, instead of paying $7,000, you would only have to pay $1,000 for the down payment. And that down payment assistance program, so that 3% would become what they call a silent second. You would have a second loan on the house, but you wouldn't have to pay on it until you sell the home. Okay, and so that's another option if you just don't have any money. I don't necessarily recommend that program, but if you have no money, we do these type of loans regularly, but of course we like to see you just have one loan. But this one does carry 2 loans. But like I said before, the second loan, you don't have to pay on it until you refinance or sell. You sell the home. Also, the down payment assistance program. Also, there's another program called the ZIP program. It will pay for your down payment, and your closing costs. And so if you have like typically zero money, let's just say you have good credit or decent credit, and you have no money, we can get you into a home loan with virtually zero out of pocket. Okay, the interest rate will be a little higher, and that's how the bank compensates for a zero down type of program. Your credit score requirement is 660. It's a little higher than the FHA. FHA 640 credit score. CalHAPA, the down payment assistance program, is 660. Okay, you have to have stable income for the last 2 years as well too. You have to have been employed in the same line of work. So if you have to be working the same type of work. So if you're a mechanic, that's fine. And let's just say you're a mechanic at Pep Boys, and you go to be a mechanic at some other, maybe mechanic shop. It's okay if you switch jobs, as long as it's in the same line of work. It's okay. If you're a baker and then you become a mechanic and you try to apply for a loan, it's going to be very difficult because you actually switch careers. So they don't like to see that. They want to see that you actually have a career and it's been stable for more than at least 2 years. Okay, so that's the down payment assistance program. The third one, which is the true zero down program, is called the VA loan. And you guys know it as the VA loan, but it's the Veteran Assistance, Veteran Administration loan. This is a true zero down loan. If you're looking to buy a $300,000 house, the down payment is zero. That's right. I mean, you pay zero down. Okay. So if you buy a $300,000 house, your loan from the bank is going to be $300,000 because you're putting zero down. You're not putting any money out of your pocket. And so this is for active and honorably discharged veterans. It's a super great program. I got my son, he's a veteran. He just purchased a home in Clovis for $375,000. and he put down zero down, and his interest rate was 2.25% fixed for 30 years. So I mean that's like an outrageously low interest rate. So the VA program typically carries super low interest rates, probably the lowest in of all the loan programs out there. Veterans is the VA loan has, I think, the best interest rates with zero down. So it's a great program. So all you veterans out there listening, you know, think about it. It's a great program. Also, too, you can buy with the VA loan, you can buy up to a fourplex. So if you, let's just say, are interested in getting a fourplex, you can live in one of those and rent out the other three. So you basically become a landlord right away. If that's your thing, that there's just a bunch of great options for the VA loan. So that's one true zero down program. The other one is called the USDA, okay, U.S. Housing Department of Agricultural loan. These are loans that are zero down, okay, but they're for rural properties only outside the city limits. So you couldn't use a USDA loan for for a home, let's say in the city of Madera. It'd have to be on the outskirts of Madera. And there's a website called USDA.gov that you can check to see if the property qualifies for USDA. Zero down as well too. Great interest rates as well too. That program is income capped, so you can't be making a lot of money. They're designed for people that are moderate to low income, and it gets them into home zero down, and the home must be in a rural area. USDA.gov, you can go there, type in the address, and it'll tell you if that particular home qualifies for USDA financing. So there's a lot of different ways to get in a home as far as down payment. I think the biggest thing that we would like to see is your credit score being at least 640. So if you have a credit score of at least 640, then you have a lot of options. It's just not one type of loan. You can have a lot of options in getting financing. Of course, typically the more you put down on a home, typically the better interest rate you'll get. But even programs that are low down payment, because the rates are so low, people are still getting great interest rates. Okay, so those are the basic type of loans there that we see that offer some kind of assistance. And so let's talk about loans that are a little different here. So there's also some other loans called conventional loans. Okay, these type of loans require typically 3 to 20% down. They may or may not carry mortgage insurance. I'll talk about that in a little bit. But conventional loans, so the difference between the other loans that I talked about, okay, let me just go back on the slide here. So these other loans here, they are typically government insured, like the FHA is a government insured loan. The CalHAPA FHA is government insured. And of course, the VA is also VA insured, government insured as well too. So these type of loans, the homes have to be in move-in condition. And so with conventional loans, which I switched over right now, the homes can be a little bit more tattered. They can need a little bit of, it's okay if they need a little bit of work. I mean, you can have some holes in the wall, maybe some broken windows, and conventional loans will finance those, as opposed to government-backed, government-insured loans. They want the home in movable condition, and move-in condition. Okay, so conventional loans typically have good interest rates as well too. And so people ask me all the time, Sid, what is the interest rate? And it all is depending on many factors. One of them is your credit score. The other one is your job stability, your down payment, and whatnot. So conventional loans have typically similar interest rates as government-backed loans as well too. Conventional loans, those are the type of loans that we give to maybe people that have better credit, because we can try to bypass mortgage insurance. Investors typically use conventional loans because they don't qualify for the other loans. By the way, the other loans here, these are owner occupied loans. So on the FHA, the down payment assistance, and the VA loans, you have to live in the home. While it's conventional loans, I'm just switching back and forth here. You don't have to live in the home. Okay, it can be an investment and whatnot. So we also see conventional loans too as well. There's also loans that are called non-prime loans. We call them bank statement loans. Typically a high down payment. So let's just say you don't do your tax. I don't know why nobody would do their taxes, but you don't do your taxes, or you just don't. If you're self-employed and you don't report enough income on your tax returns to qualify for a home, then we can switch you into a bank statement program as well too. We don't do a lot of those, but they're out there. There's a lot of different products out there, but that's one of them there. Okay. So let's talk a little bit about a little bit of verbiage of loan verbiage, because it's important. So if you ever do decide to get a loan, you're going to want to know what your how much is it going to cost to close the transaction out. Okay, you don't want to be left in the blue about what it's going to cost to close the deal out. Well, nowadays, all banks, all mortgage brokers, they're required to issue at the beginning of the application process what they call a loan estimate. We call it an LE for short, but you'll hear that from the loan officer lingo. But what it is, it's a loan estimate. It's all the details and the terms of your loan, including the expenses, monthly payment, loan terms, and closing costs. So let's just say you do get qualified for a loan. Let's just say you want to buy a home and you want to do the FHA 3.5% down, and you go to a loan officer and they get all your documents and your credit is good enough, and you get a realtor and you go out and find a house and you get it accepted and you're in escrow. And the first thing the loan officer is going to do, or the bank's going to do, is they're going to issue you within a couple of days. They're going to issue you a loan estimate, and it's going to tell you what your interest rate is going to be. It's more likely going to be a floating rate. And so it's going to show your interest rate. It's going to show you what we call cash to close. It's going to say, okay, before we even start the whole 30-day process of closing this deal out, you're going to need X amount of dollars, okay, to close this deal out. Do you have that money? Okay. And let's just give an example. You're going to need $10,000. Okay. This is what our estimate is. So that 10,000 will be broken into where that money is going. Who's getting that $10,000? Where's this 500 going? Where's that 1,000 going? And so on. So the loan estimate is an estimate. It's not the final figures. It is an estimate of how much it's going to cost to close the transaction out. And you should get that. You should get that loan estimate at the very beginning, okay, of the transaction. That way you know if you want to proceed or not, okay? Because at the very end, now let's talk about the CD, or the closing disclosures, okay? At the very end of the 30-day transaction, you're going to get what they call a closing disclosure, and it's typically 3 days before you close the deal out. Then it's going to have pretty much the final figures and of what it's going to cost to close the deal out. And so you're going to know exactly how much it's going to cost you to close the deal out, and the loan estimate and the closing disclosure should be very similar in cost. There shouldn't be any surprises, because the last thing you want to do is, the last thing you want is for the loan officer to tell you, hey, it's going to cost $10,000 to close the deal, and they tell you that at the very beginning, and at the very end they tell you, hey, it changed to 20,000. So in order to avoid that, that's why you have the loan estimate, okay, and that's why you get the closing disclosure right at the very end of the transaction, and it should be very similar. There's a small percentage gap for different changes, or depending on when you close a transaction, property taxes, insurance, and whatnot. So, but it should be very similar. So you shouldn't have any surprises when it comes to closing a loan. Okay, so that's what those terms are. Just remember those when you're actually applying for a loan, wherever you decide to apply for a loan. When you're applying, remember right after you either refinance, right after you start the refinance process, or you get into escrow, ask your loan officer for the loan estimate. Okay, so let's keep on going. Some commonly asked questions that you might want to, you think about or might want to know about. What are points, right? You hear the term, what are points? Points are typically the cost to secure lower interest rates. So you can actually you can actually do what they call buy down. If you want a lower interest rate, let's just say you're getting a 3.25 interest rate, and that's not good enough for you. You want to get a 2.5 or 2.8. You can buy down the interest rate. You can give the bank extra money or points to buy down the interest rate. We don't see it a whole lot because when you calculate everything, it's just sometimes it's not worth it. But you have that option of buying down your interest rate through your points. Okay, so there's that. Can you buy a condo? Okay, we get a lot of people asking, hey, what are the requirements of buying a condo? Well, they're basically the same as getting a regular house, but your interest rate may be a little higher. Okay, and typically the bank want to see the condos have at least 51% owner occupied. So the banks, they don't like to lend money on condominium complexes where it's like 100% renters or 90% renters, because they just don't like that scenario. They typically want to see 51% of the condominium complex owned by actual people living in people actually living in there, and the whole complex not being rented out. There's also manufactured home. It's not in here, but there's manufactured home financing. So a lot, especially like in Madera County, we'll see people that, hey, you know what? I want to buy 2 acres with a mobile home on it. And so typically that would be a little more difficult to finance. The mobile home has to be on a permanent foundation. It has to be registered. It has to be a true permanent foundation. But we can do that, we can do, or banks can do those, loan officers can do that type of financing. We do them every once in a while. And those are great. I mean, they're great loans because, you get typically a lot of acreage or a couple of acres with the mobile home. People like that sometimes. So the next question here that we get commonly asked is, what kind of insurance do I need to close the deal out? Okay, there's typically 3 types of insurances that you're going to need to insure to close a real estate transaction. Okay, the first one is what they call hazard insurance. So the bank is not going to lend you money unless you have homeowners insurance in place. Because I mean, why would a bank lend you $200,000, $300,000, $400,000, $500,000, and then right after that, the house burns down, and then the bank, then you stop making the payments, and then the bank goes, well, you stop making the payments, we're going to foreclose, and then they foreclose on bare land. So the bank wants to know, hey, if we're going to lend you this money, we want to see homeowners insurance in place before we close the deal, and we want you to pay 3, 6, 9 months ahead, okay, so that you have a cushion to just in case you lose your job, there's a savings account to pay for that homeowners insurance. Okay, and so that's why they want that. That's one insurance. The other type of insurance is what they call title insurance, and title insurance is to secure the chain of title. So when you buy a home, you know that it's actually legally yours, and no one comes back and tries to claim the house. Like somebody comes and says, hey, that's my house, and somebody committed fraud 5 years ago and they took the house from me, and now you own it. I'm not, it's really my house. So title insurance helps ensure the chain of title. So a title search is done, making sure there's no liens on the property. so that when it gets transferred in your name, you feel confident that you don't have to worry about anything. The home is yours, and you have title insurance just in case somebody tries to uh, claim the property as theirs. So that's the other type of insurance. And so banks won't fund loans unless you do a title search and have title insurance in place. The third type of insurance, which sometimes applies, is what they call PMI, um, what we call mortgage insurance. Okay, what is that mortgage insurance for? The mortgage insurance is if you typically owe less than if you have typically less than 20% equity in your home, the bank will require mortgage insurance. So if, let's just say you put like the FHA loan, you would put 3.5% down, you would need mortgage insurance on an FHA loan. On a conventional loan, typically, depending on the program, you would need mortgage insurance, okay? And so this is because you have less than 20% equity, the bank requires this. So now you would have basically 3 payments, or actually 4 payments, okay? You would have the payment to your bank, the payment to the homeowner's insurance, property taxes, and then your mortgage insurance. So typically you would have all these costs in one monthly payment, in one lump sum. So when you get a mortgage statement, you would see all these costs in there in just one payment, okay? So that's that. And the good thing, going back to the VA loan, I love the VA loan because the VA loan has no mortgage insurance. So you're putting down zero down. The only loan program not to have any mortgage insurance, okay, typically is the VA loan, no mortgage insurance. So that could be a big cost. You know, it could be anywhere from $50 to a couple $100 extra per month that you're paying. So the VA loan doesn't have that. That's why I love that program so much. Okay, so let's keep on going. A couple other things to think about. You might want to do a home inspection on the property because the banks, sometimes the banks won't fund, they won't fund a home. Like, let's just say, I see a lot of houses, well, not a lot, but you know, there's homes out there that have what they call the shake roofs, which are kind of becoming obsolete. But a lot of times the banks won't fund houses with shake roofs because they're just so tore up by now. I mean, you know, they're just really tattered. They have you know, leaking issues. So a lot of times when you do a home inspection or the appraiser goes out there and the appraiser might say, you know what, this home, I noticed the roof is really torn up. And then the bank sees that appraisal and they might call out. The bank might say, we're not going to give this money because the appraiser sent us pictures. We're not going to give this money to you to fund this deal unless somebody fixes the roof. Okay, so be careful. You know, kind of be careful when you're buying a home that you inspect it properly and you know what you're buying, because it's a buyer beware. Once that transaction closes, it's super difficult to give that home back to the seller. It's difficult to, you know, the banks already funded the deal there. It's hard to, you know, to get that, to do something once you purchase the home. So make sure you do due diligence way ahead of time and don't do it afterwards. So we typically what we would recommend when purchasing a home, and the bank would like to see a lot of times, is a termite report, okay? Termite inspection, termite report, roof inspection, and maybe a home inspection. You know, have somebody go out there and inspect the home to make sure just a lot of other things are clicking together as far as like the condition of the home. You know what you're buying, electrical, plumbing, that kind of stuff. That you can purchase what they call a home warranty, which covers which typically about $650 a home warranty, and it would cover all the major appliances, plumbing, electrical, AC, heater, all those really costly things if they break down. So those are the things that a home warranty would cover as well too. Okay, so let's keep on going here. and move on. Uh, just a couple of things, monthly payments, typically you would get your mortgage statement in the mail. Typically when you close a loan, you would skip a month. So like, let's just say the loan closes in, what are we right now, in April? Let's just say you close escrow today. So you would typically not see a mortgage payment till June 1st. So you would skip a month. That's always nice because you get a little break on making that mortgage payment. But you would send your mortgage payments directly to the bank through the mail. But nowadays, most people just get it out of their bank account. That way you don't worry about missing the payment. You can electronically send your mortgage payment to the bank. Another thing too, while I'm talking about that, what a lot of people don't know is that I tell my clients all the time, I say, listen, you got a 30-year loan, okay? If you make one extra payment per year, you can knock that 30-year loan down to about a 22, 23-year loan. So that's just a little trick, the trade, a little secret. Make one extra payment a year, you'll knock your loan down about 7 years, okay, if you have a 30-year mortgage. So what would the let me just go down this part here. It says what your monthly payment would include. So what we typically see on a mortgage, on a monthly payment, let's just say you get like a mortgage statement, okay, from the bank after you close the home, and you get a mortgage statement and it says, please send $1,200 to the bank, okay. Well, if we break that $1,200 down, typically you're paying out 3 to 4 different entities there. And so typically that $1,200 will include a big portion of that $1,200. Let's just say $700 will go to the bank, and then a couple $100 will go to the insurance company, and then another $100 will go to property taxes, and then another $100 will go to the mortgage insurance that you have to pay because you didn't put down more than 20%. Okay, so your monthly payment will typically include all those different costs all in one payment. And so typically you will get what they call an escrow account. An escrow account is a savings account that the bank has for you. Okay, and so that's where a lot of the money is held. And so there's that right there. Okay, that's what your monthly payment includes there. So just other obligations to, just some other things to think about, okay, when you're purchasing a home is, make sure, a home, when you're buying a home, it's just not buying a home. Homes are very, they're always needing work, okay? So just be aware that when you're getting into a home, think about, first, not just being able to afford the monthly payment, that's okay, but there's going to be other costs involved in owning a home. So something like, who's going to cut the lawn, the maintenance of the front yard, the maintenance of the backyard, the upkeep of the home. What if some plumbing breaks down? What if there's a leaky roof? What if you want to remodel a home? What if there's some trees that are, overgrown in the front or backyard? There's so many different things. So sometimes, it may not be the best time for you to buy a home. Just because you can afford the monthly payment doesn't mean that you should get into a home, okay? I'm a big advocate of owning your home at the right time, but you got to be aware that there are going to be other costs involved besides making the mortgage payment. There's going to be other costs involved. Otherwise, what's going to happen is that your home will slowly start to deteriorate and lose value. And the banks don't like to see that. They want, part of the deal is that you upkeep the home in a good condition, because they don't want to see that home lose equity and value in the home. So something to think about when you're purchasing a home, there's going to be other costs involved. And so we don't like to see, our borrowers be what they call, home heavy, or all their income. I mean, if you're making, like example, if you're making $5,000 a month and your mortgage payment is $2,500, that's half of your income. typically the banks want to see you paying about 40% of your income maximum should go to making your house payment, because they understand that you have to have income to help subsidize the cost of owning a home, and living expenses in general, as they've gone up, food, uh, gas, all other expenses that you have in your life. So you be careful. A loan officer, can help you decide if owning a home or purchasing a home or getting a home loan is right for you at the time. So they will go over your financial, they'll go over your income, they'll go over your debt. They'll tell you, hey, maybe you should pay off, the car first, and then we can get you into a home. So a loan officer should be able to financially help you with making that right decision in owning a home. Okay, so there's that. A little bit about real estate agents. So just really quick here, so you guys know what real estate agents do. Loan officers are in charge of the money part. Okay, and real estate agents are in charge of the other part. So we loan brokers, mortgage brokers, loan officers, basically the same thing. We're in charge of qualifying you, getting you the money, helping you through all, understand the cost involved. But the real estate agents in charge of finding you the home, scheduling the appointments to look inside the houses, telling you about the market conditions in your area. Right now, I'm going to tell you something. The market is pretty rough for buyers. I'm not trying to discourage you, but there's I'm not sure if it's because of the pandemic. More likely, it's the pandemic. People, sellers are kind of hesitant for people to go into the homes. Plus, the interest rates are super low, so we got tons of people applying for home loans. But anyways, the realtor will tell you what the market is like out there. Okay, they'll help you negotiate a price for the home. They'll set up appointments, and they're the ones that give you the keys to the home. The loan officer doesn't give you the keys to the home. The real estate agent gives you the keys to the home. The escrow company, what do? Okay, they're the third party. They're a third neutral party. They're the ones in charge of getting all the paperwork from all the parties, from the buyers, from the sellers, from the loan officer. So basically the buyers, the sellers, and the loan and bank, the loan officer, they send all their stuff to the escrow company. The escrow company sorts everything out. They work out all the numbers, do proration of taxes. They receive deposits on good faith deposits when you make an offer on the home. They order what they call preliminary reports. They check for liens. They order natural hazard reports on the area, natural hazards. And they're the ones that actually record the property in their name. At the very end, the title company is the one that sends the recording to the county recorder's office in Madera, and they're the ones that actually call and tell you, hey, you know what, the property is now in your name. You're the owner of the property now. Congratulations. Okay, so everybody has a role in the buying of a home. That's why purchasing a home can be very complicated, and you want to work with professionals. So my last bit of advice here, that's just a little bit of information there about us there, our number and our website and whatnot. But just a little bit, last little bit of advice I hear. I know we're going to be finishing up on our time here, David. But please, when you purchase a home, use a professional, use an experienced loan officer, use an experienced realtor, use an escrow company. Okay, these are important because you're not buying like a cell phone that's $800, $1,000. You're the biggest investment that the average American is going to make is going to be purchasing a home, and they're going to be spending nowadays, $250, $350, $400, $500, $600,000. It's a giant chunk. Okay, so you want to be guided by an experienced loan officer. You want to be guided by an experienced real estate agent, so that they can help make the process go a lot smoother, a lot less stress-free, and make the experience actually a positive experience for you. Okay, So I hope this has helped you out a little bit in, maybe asking some basic questions about uh, financing and a little bit about the home buying process. I'm a big advocate for, people. I mean, there's all kinds of studies out there about owning your home, what the benefits are. I would love to see every single person, own a home, if it's a right time for them to buy, because owning a home, I mean, there's just so much stability. Your kids don't have to worry about, uh, switching schools. You're going to be home. You can paint, you can paint your home, you know, any color you want. You can decorate it. You can add, there's just so much. There's a lot of security for the family. Buying a home also stimulates the economy, because when you buy a home, the first thing you do is jet up to Home Depot, or you call the contractor to fix things. And so it stimulates the economy. It's a great, and and the interest rates are so low right now. It's a great time to get into a home, okay, if you can get one right now. But that's all I have. Thank you very much, David, and the rest of the staff, for allowing me to, take a little time and talk about the financing. And if you guys have any questions, go ahead and contact David, and we'd be happy to hook us up and answer your more questions. Thank you very much for your time, David. I appreciate everything.
Thank you, Sid. And this was incredible. This was great information, very thorough, very comprehensive. And you really did answer many questions that typically people have when they are engaging in this huge role that people take in their lives. And that is taking that huge plunge into home ownership. It's not an easy task, and it's something that people really do need to do their homework, their research, so that they can make sure that they are doing the right thing. I think overall is for them, and you said it, for them to have the best possible experience as they're going through this entire process. So I think that you have definitely opened an awareness, which is exactly what we intended to do for the community, and that is to create some awareness in terms of what is the process, what are some of the terms, what happens during the process, and knowing that there's lots of help out there. I know that we are going to open it up for a couple of minutes, because we do have a couple more minutes. If there's anyone that has any specific questions, you can post them on the Q&A, question and answer. If there aren't any, not a problem. That just means that Sid was very thorough in his explanation. And I know that I don't want people to forget that there's a lot of opportunities out there for new homeowners or home buyers. And so I know that the city of Madera, the county, different outlining cities have all of these special programs to enable individuals who are going to be buying their home for the very first time to, obtain the support and education that they need, because I know that they also have classes that people can go through to dive deeper into some of the information that you provided for them today. So is there anything else in the area of home ownership opportunities for new home buyers that are out there on the horizon that maybe you can share with us?
Well, the state of California occasionally will provide home buyer grants. And so to help people with, like, if they don't have any kind of down payment, they will help them with giving them a free money, basically free money for the down payment. And it wouldn't be a second loan or anything like that, but that would be, something that comes up every once in a while. I would just say, talk to your loan officer connection about what programs are out there, because they're constantly changing, and so that's what I would say. Yeah. There's always a lot of stuff out there.
So thank you so much, Sid. Again, we thank you once again for all the information that you have provided. Please, audience, don't forget that we do have upcoming seminars in alignment with the series that we have for finance literacy. So real estate, how to buy and sell, all the process that goes with it is on May 4th, credit repairs on May 11th, and benefits of insurance is on May 18th. If you
So
need more
good.
information about some of the upcoming classes, feel free to call the Madera Unified School District call center. You can reach the call center at 416-5879. I'll repeat the number. That is 416-5879. The call
David,
center.
we sorry to interrupt, but we do have a question.
Oh, go ahead.
It's from Rosa, and she's asking, if I don't have good credit, can I use a cosigner?
Well, you can use, Rosa, you can use a cosigner. The only bad thing is that we always use the lowest credit score of the both borrowers. So to answer your question, you can bring in a cosigner, but we're gonna use the lowest credit score of the both. And so if you don't qualify, if you don't have the 640 credit score, then you won't be able to qualify. Yeah, typically we see a cosigner is good. Like if I'm only making, like if I have a 640 credit score and I'm only making $2,000 a month, then I can bring in my mom and she's making, $3,000 a month in retirement. Then we could add those two together, and now both parties are making $5,000 a month, and now we can qualify them for more. But we always use the lowest credit score of both parties. And so, yeah, you would have to work on your credit score if your credit score is not 640 or better.
Okay,
You're
thank
welcome.
you. Also, can we remind our viewers that we will be having the same webinar in Spanish on Thursday, because we are getting some questions in regards to the Spanish speaking community.
Yeah, absolutely.
Yeah, I will be there. I'll be here Thursday doing it in Spanish.
Entonces es un recordatorio para la audiencia que el próximo jueves el señor Cid nos va a acompañar de nuevo para hablar sobre este tema. Hoy se le dio la información en inglés, pero el jueves va a ser totalmente en español. Así que nos acompañen, por favor, para el enlace, por favor, ocurre al Parent Square para que puedan recibir el link, el enlace para acompañar. Muchas gracias nuevamente. Thank you so much to everyone who participated. Erica, is there any additional questions before we end the seminar?
Yes, I do see a question from Frances on Facebook, and she's saying, what's the minimum credit score to qualify for a program for first-time buyers?
It's typically 640. You would need a credit score of 640 to qualify for FHA loan. First-time home buyers, well, you might be talking about the zero down program. First-time home buyer, you would need a 660 credit score. Zero down.
Okay, Francis, there you go. Thank you, Sid.
Any more?
No, I don't see any more.
Okay, we are at just 3 minutes over. So once again, thank you so much, Sid. Looking forward to seeing you on Thursday as you address the Spanish-speaking audience. Everyone who worked on this project, thank you so much. And this concludes the seminar. Have a great night.
Thank you.
Thank you, Sid.
Yeah, take care.